Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Hello and welcome to the Southeast Retirement Planners Podcast. I'm Ryan Edwards. I'm here today with Jamie Eckard. This is part two in our two-part series, if you will, about tax planning versus tax strategy, if you will, or tax prep versus tax strategy. And we're kind of picking up today, if you will, and hitting the ground running, talking about the pillars of a year-round tax strategy. And with that, as we jump in, before we jump in, I just wanted to make sure that you're aware that Jamie is the lead of Southeast Tax and Consulting, a newly formed firm, sister with Southeast Retirement Planners, and we're happy to have him here with us today, a long-tenured CPA, and he's going to share some insight with us, and together we're going to share what we see in terms of planning strategies for clients and some things that you need to be aware of. Now, this is a little bit more of a lengthy podcast today, so we're going to I'd encourage you, as you see some of the bullet points that you'll see on the screen or that we talk about, that you maybe make notes or maybe make some mental notes, and if something triggers your mind, come back to a certain part about it. And we'll also be trying to send out some clips about this. So as we jump in, we're going to talk about some of these pillars of of year-round tax strategy. So we're usually working across a few key areas, and let's go through those. So we're talking about income timing, how and where your money is invested from a tax perspective, charitable giving, Roth contributions and conversions, tax loss harvesting, and then estate and gift taxes for large estates.
Right, Ron. This is a good thing to look at it as if it's a menu. Not every tactic will be used for every person. We're not trying to pull every lever every year. The value comes from looking at your situation in an organized way and deciding which levers make sense now and which are better saved for later. Right.
Okay. And this is where having a simple tax calendar can help, and we'll talk about that a little bit later. Instead of thinking about taxes about just a few frantic weeks in March and April, as I said, we'll talk about that a little bit later. Things you can do middle of the year and toward the end of the year, so things become a little bit part of your regular planning rhythm.
Right, and before we get to timing, maybe we could start now with the income timing. It actually works in practice because that's one of the most first areas a coordinated strategy can have a real impact. And we look on this for income timing, managing when income shows up. Income timing is simply about when the income shows up on your tax return and when its deductions show up. You cannot move everything. Your salary is typically fixed, but there are areas when you have some flexibility, though.
Okay, and examples that can come often in my work are timing a bonus, deciding which year to take a discretionary distribution from a retirement account, or when to recognize income from things like U.S. Treasury bills or self-employment work.
Right. The classic move here is to defer income into a future tax year and pull deductions into a current tax year. Okay. So you lower this year's tax bill. But that's not always the right answer. If you're in a higher tax bracket next year and you know that, you may want to pull some of that income into the current year. And as far as deductions, the same thing. If you're going to be in a higher tax bracket, that deduction you have in December, you may want to put to January, so you'll have more deductions allocated to that higher tax bracket.
Okay. So this is really this is where projections really matter, kind of sitting down together and looking at expected income and for this year and next. And then I assume we have in the past, and you model out different scenarios where to take the most advantage of those brackets, and how brackets may have changed.
Yeah, and they do. Right, correct, Ron. Okay. They do typically, and that's the decisions. You don't want to make decisions in a vacuum. Right. You know, the same move, it looks good in one tax standpoint, may not be the same for everybody. Yeah. So you want to make sure that you're analyzing those, chase every possible tax savings. It's made a coordinated decision that fit your broader goals.
Right. All right. Well, good stuff. So let's go to another one, tax-advantaged investing and some of the Secure Act 2.0 changes. So this is another pillar, and traditional retirement accounts are still one of the most effective tools we have in managing our taxable income.
True, absolutely. A traditional 401k or similar plan lets you defer part of what you pay. Part of your pay, which reduces your taxable income the year you contribute. The money then grows in the current taxation, and you pay income later when you withdraw it in retirement.
Yeah, so you need to know your limits, your contribution limits for 2026. You can defer up to $24,500. If you're 50 and older, you can put in an additional $8,000. That's considered a catch-up. And there's been some updates as well. So a good example of something we want to review each year as part of your strategy if you're able to put in that much and reduce your income.
True, and that follows also the Secure 2.0 rules, which they added a few twists this year. You know, one that surprises people is that you're 50 or older and earn more than $150,000 in the previous year. Your catch-up contributions can only be Roth contributions. Right. And that's, you know, and that must be meaning they are after tax, even if your base contributions are pre-tax.
Right. Okay. So you after $150,000, not getting that tax deduction.
Exactly.
So, yeah.
Exactly. That's limited. Now it may help in the long run, depending on what you're choosing to do.
Yeah. Now we've got a lot of questions on this next thing. So there's also called a super catch-up, and that's for individuals ages 60 to 63. During that year, those participants can contribute an extra $11,250 to certain plans like a 401k or a 403b, and even governmental plans that are 457b plans. Now that creates a powerful opportunity for individuals that are able to defer and able to save that amount that they in your final working years, if you want to kind of accelerate your retirement savings.
Right. And then like you said before, the brackets and everything, they're not static. That's the same thing to do with contribution limits here as well. You know, part of a good tax strategy is simply staying current, making your saving pattern is aligned with the latest rules rather than last year's assumptions.
Right. The more you coordinate those decisions with your long-term plan, the more strategic you can be. And, for example, deciding whether it makes sense for you to prioritize pre-tax contributions, Roth contributions, or a mix of the two. So that's some good on that topic. That's good. Now let's transition. We can get into the weeds and spend a lot of time on all these, but let's move over to charitable giving as a tax strategy tool. So for many clients, giving is a values-driven first idea for them and premise, but with the right structure, it can also help manage taxes.
Right. In our one big beautiful tax bill, a number of charitable rules have changed, started in 2026 as well. One of the headline items is now the new above-line charitable deduction for people who do not itemize. Not everybody itemizes, Ryan, because they don't have enough taxes and charitable giving and other types of things to put them in that itemized income. Itemized deductions. This one is single filers can potentially deduct $1,000 of cash gifts to public charities, and married couples can deduct $2,000, subject to the rules, even if they use the standard deduction, which allows, to get a little piece of the pie from the itemized deduction section.
Yeah, so that's something a lot of people listening, the vast number of people now, since the standard deduction has increased so much, since the Trump tax cuts took account before 2020, before, and then they've got reenacted here just recently. Even less people itemize. So and therefore, this is something to make sure you take advantage of that what's called the above the line deduction. That's something that you can take advantage of, as Jamie said, even if you are taking the standard deduction. Make sure you don't lose that. So there's a new floor for itemizers. This is kind of getting the weeds, but there's only a portion of your charitable giving that exceeds 0.5% for your adjusted income. Gross income will be deductible. And for very high income earners, the value of your itemized deductions, including charitable gifts, is capped at 35% of your benefit.
Right.
So there's a little bit of, if you got questions about that, that's the reason you need to call in and talk to you.
Right. I mean, although, 35%, that's a good amount depending on what your income level is, but they're also not going to let you give 100% away to reduce your taxable income to
Correct.
zero. So that's why the standard deduction helped a little bit, the increase in that. I believe it was 2018. One other thing, we have qualified charitable distributions are another very important tool. If you're at least 70 and a half, you can give directly from an IRA to a qualified charity. That donation can satisfy all or part of your required minimum distribution. It does not show up as taxable income, Ron. For 2026, the QCD, qualified charitable distributions limit, rises to $111,000.
And we're talking about that a lot in our office, and we're conducting those. It's a conversation we're having. A lot of people in our that we work with are they've given for years to a charity that's close to their heart or to their church. It has to be a nonprofit. It has to be an official charity, an official nonprofit to qualify. So that's something to certainly consider, and it can be very beneficial. But for high net worth households, another thing is donor advised funds, and they can be very, very effective. What you do is you give cash or appreciated securities to that fund, and you get a deduction in that year if you qualify, and then you can grant money out to charities over time. So you can put it in that fund, but then you can get the deduction in that year, and it separates the timing of that tax deduction from the timing of the gifts.
Right. I mean, that flexibility comes especially valuable in years when your income spikes. That's not all the time, but you may have those years where that does. You might choose to bunch several years of giving into one tax year in order to itemize and get more value from your deductions. Then use the donor advised fund to support charities steadily in the following years.
Yeah,
then that goes against your 35% cap too. We still got to think about that as well. And again, come giving that's in your plan and your strategy to make sure we take advantage of as much as we can.
The key is planning, and if you know your giving goals and your income picture, we can work with your CPA or give you a call and to determine whether the strategies like QCDs, bundling, or donor advised funds make sense.
Right.
And if so, when?
Right. Also it coincides with, Roth contributions and conversions, paying now versus later. Let's move to the Roth accounts because they are central to any discussion about paying now versus paying later. With a Roth IRA, you contribute after-tax dollars, and if certain rules are met, your earnings withdrawals can be tax-free at the time you distribute those.
Right. And one of the bigger strategic questions we discuss with clients is whether a Roth conversion makes sense at all, and that means moving money from a pre-tax retirement account into a Roth IRA. So you pay tax on the amount converted in that year, but future qualified withdrawals are not taxed.
Right. And the trap is that a full conversion in 1 year can push you in a much higher tax bracket. That is why many people look at partial conversions over several years, often targeting low income years for required minimum distributions.
Right. So partials are kind of tax bracket management, if you will, is a phrase we like to use too. Is making sure that you're aware of where you're at and where you don't want to cross over that next level.
Right. It's where we. So, excuse me. Sorry about that.
Well, I mean, no, I didn't mean to cut you off, but that's something where you're actively paying attention to those brackets, and it's important to sit down with the on the planning side there at the end of the year to make sure you don't go over that bracket, right?
Right. And we keep coming back to the planning and strategy because that is key in these situations we're talking about. You can't just really throw a number out there with these top things. When we build a tax strategy with clients, Roth decisions sit alongside everything else. We look at your projected tax brackets, your other sources of income, your charitable plans, the legacy you want to leave. And the goal is not simply to own Roth accounts. It is to use them in a way that supports your broader plan too.
Right. That's good. Well, you'll hear if you hadn't worked with us before, but if you call in, and that's something we're always having conversations with clients, and it's something that because tax-free income, and it can be a great planning tool for individuals. But let's go on to our next pillar, if you will, and that's tax loss harvesting and investment decisions. So it is another tool. It's one that gets a lot of attention, especially in volatile markets. And that's tax loss harvesting. In simple terms, that's selling an investment at a loss and using it to offset capital gains elsewhere.
Right, right. And, losses you realize can offset gains in other investments. Now, this is probably a little more in the detail will come, but that also comes from if your losses exceed your gains, you can usually offset to a limited amount of ordinary income each year and carry the rest forward. Now, that's when it comes into your passive and non-passive items there. Mm-hmm. Like I said, that's a little deeper conversation, but it can use well to if you're going to free up some passive income next year to save those passive losses as well. And it can be useful to soften the tax impact of rebalancing and concentrated stock positions.
Right. So there's two important nuances that. First, long-term losses must be used against long-term gains before you even can apply them to short-term gains and vice versa. And second, the wash sale rule applies and prevents you from claiming a loss on if you buy the same stock that or a substantially identical security within 30 days before or after the sale took place. So
right.
That's something we pay attention and follow for clients. But certainly these situations we're talking about are in in non-IRA accounts.
Right. Yeah. I mean, also from my perspective, the caution is that the tax tail should not wag an investment dog. We never want to sell a holding that is still a strong fit for your long-term strategy just to create a loss. Who wants to do that? A lot of times there may be tax advantages, but they're not cash advantages because the tax rate is not 100%.
Yeah,
at the same time. This is a tool that works best when your investment plan and tax plans are coordinated.
Yeah, that's a good point. Good point. Good stuff. Well, let's go on into the estate and gift taxes, planning for what you leave behind, if you will. So for families with significant wealth, estate and gift taxes are an important piece of the tax strategy conversation. And the One Big Beautiful Bill Act gave us more clarity here on this topic.
Right. The law sets the federal estate and gift tax exemption at $15 million per person or $30 million for married couples, indexed for inflation, of course. This is a very high number, which means more than 99% of estates will not face a federal estate tax.
Okay. Yeah. So, but for clients whose estates are over that threshold, the tax rate's 40% on that excess. And separate from federal rules, some states still have their own estate and inheritance taxes at much lower levels.
Right. And this comes, too, with your accounting at the end of the day, too, to get that reduction as much as possible. And that's where techniques like lifetime giving, spousal trust, and other structures come in. You can move assets out of your taxable estate, often while providing a spouse or future generations. But it has to be done carefully and in coordination with your estate attorney and advisor.
Right. So even if your estate is below the federal threshold, the same mindset needs to apply, if you will. So the earlier you start talking about what you want to happen with your assets, the more options you have to align your tax picture, your legacy, and kind of your family dynamics, if you will.
Right. And this moves us into the next segment, is avoiding common tax surprises and using a calendar. So let's talk about surprises. Because many are unpleasant tax experience, we are avoidable with a little planning.
Right. One of the first ones is quarterly estimated taxes. That's a big one. If you have income that does not have withholding, like self-employment income or certain investment income, you may need to make quarterly payments. And if you don't do it, you can face penalties, even if you pay your full bill by April.
Right, because the IRS have safe harbor, rules that can help you avoid underpayment penalties. I mean, for example, paying at least 90% of the current year tax or 100% of the prior year tax, subject to income levels. But you have to know where you stand during the year, not after the fact. There's also safe harbor rules for couples that are married filing joint over $150,000, which require you to pay 110% of prior year tax.
Okay, well, that's mercy. Nobody likes cutting those checks, but no, you certainly don't like to pay a penalty either. So
correct.
So another surprise we see around withdrawals from tax-deferred retirement plans. People are sometimes caught off guard when they realize that they have to pay, realize that every dollar that they take from traditional IRAs or 401ks is taxed as ordinary income. It goes down as just like income they earned, or if you will, I guess, the ordinary income, and that required minimum distributions are the same, and it pushes their income and therefore their tax bracket higher.
Right. And this is where coordinated retirement income strategy is critical. I don't think we can stress this enough as far as the planning and the strategy comes in. We can plan the sequence of withdrawals from traditional accounts, Roth accounts, taxable investment accounts, and coordinate that with Social Security timing and charitable moves. This way you understand in advance what your tax picture, will look like.
All right. So to keep all of this manageable, we often suggest a simple tax calendar. So I'm going to try to kind of simplify this, if you will. And so we got February and March. That's when everybody's focusing on filing the returns or extensions and making final IRA contributions, because you have until the deadline, April 15th, and you're reviewing last year's return, and you're paying first quarter estimates. Okay, so then April comes up, and April through June, you kind of review your income and withholding and make second quarter payments. And you look at early tax loss harvesting opportunities if the markets have moved. Like last past year, we had a pretty volatile April in the market. So that would have been in hindsight, that would have been using that as an example. So in July through September, you kind of revisit. That's a good time to revisit your charitable plan. Do you have intentions of giving money to a charity by the end of the year? Evaluate the pros and cons of Roth conversions. That's kind of when we are in our office looking for opportunities in that regard for clients. Then you make your third quarter payments. Now from October through December, that's when you finish any tax loss harvesting, because you got to have it done by the end of the year. And your advisor, any that your advisor thinks makes sense, maximizes. That's also a good time to maximize your retirement contributions, including any catch-ups, if appropriate, if you qualify for them being over 50 or that super catch-up 60 to 63. It also, maybe you consider bundling charitable gifts. Decide on the timing of any bonuses or discretionary income. I've got some people that get bonuses in December. Right. Maybe that's a good time to, increase your 401k for that month. Not hurt your cash flow, but don't get hit by Uncle Sam that much.
Well, the bonus, rate is higher, much higher. If you have a lower income tax bracket, bonuses can be taxed between 25 and 40%, which is a lot. So you really got to concentrate on the plan there. Right. And I like what you said about quarterly estimates as well. A lot of people print out, okay, if you owe $20,000 a quarter, you're going to pay $80,000. Well, looking at these strategies, February to March, and like you went on April to June, October, or from July to September, and from October through December, those can fluctuate. You may not have a fourth quarter estimate if you do tax planning and strategy, which saves money where you can put it in other areas. When you spread the work out that way, taxes become a part of your ongoing planning cycle instead of a once a year scramble, and that's what a lot of times it is. It is the same set of decisions, but maybe with more time and less stress too.
Yeah, well, this has been I know a lot of information today, but let's go through kind of as we wrap up, kind of as we close, just some next steps to kind of put this all together. Tax preparation is about accuracy and compliance, and it records what has already happened. But tax strategy is about shaping what comes next over many years, not just one. Right,
exactly. And the most effective tax strategies are really about a single technique, on its own. They come from coordinating everything we discussed today: income timing, tax advantage saving, charitable planning, Roth decisions, investment moves, and estate and gift strategies. And doing that in a way that supports your goals. Those are a lot of things you got to focus on there. But, defining those, they might all fit your menu, as we said before. Right. But, noticing those things and picking those out and going into more detail is a great thing to do.
That's good. So if today's discussion has kind of piqued your interest or raised some questions for you, a good next step would be to sit down with your financial advisor and a tax professional and ask, what does my tax strategy actually look like today, and what might we need to adjust for 2026, if you will. So we're going to be certainly with the doing some more conversations and have the ability to have more conversations with our clients going forward, and be able to get more answers for clients going forward as we have more time. So as a new resource.
We're here to help you move from a once-a-year tax filing mindset to a year-round collaborative approach. Thank you for joining us, and please reach out if you would like to explore how these ideas might apply to your own situation.
Yeah, thanks for everyone for being here today to the Southeast Retirement Planners podcast, and we appreciate your time and look forward to having future conversations with you if you're a client. And then if you don't work with us currently, we'd love the opportunity to sit down and talk about your situation. We offer a complimentary financial checkup, and we'd love the opportunity to do so. Just simply give our office a call or reach out to us online at www.seretirementplanners.com, or you can look at on the screen and catch us at one of those numbers as well. So, Jamie, thank you for joining us.
Thank you, Ryan. I appreciate it.
Southeast Tax and Consulting Services are not affiliated with or endorsed by LPL Financial. Tax preparation services offered through Southeast Tax and Consulting Services are separate and not affiliated with LPL Financial. LPL Financial does not offer tax advice or tax preparation services.